If I have a bunch of money, I can be an angel investor. How true is that?
You can be an angel investor. You may not be a great one.
Anirudh Damani,
Anirudh Damani.
the managing partner at Artha Venture Fund.
Where he's shaping the future of startups.
Previously,
He was an angel investor.
in trailblazers like OYO Rooms, Purplle, and Rapido.
And I've heard family offices like, we did 100 investments last year. I said, how? We got a 2% team, 20 people working. We can barely do 10 deals in a year. They invest, then they don't follow up, they don't nurture, and then you'll be like, "Ki, arey, maine 100 company mein dala tha. 85 of them failed, 5 of them ran away with the money, 10 I don't know what the heck is going on." So this is a really bad investment for them.
I've got 500 rupee notes. I've got 10 of them. And if you had to take this money and sort of allocate it when it comes to angel investing, all the factors that go into it, how would you do it?
This is how I would allocate it, right? Seed investing should have about 1/7 of the capital. Then as the company grows, at that point, you will double your check. So that's 2,000, right? And now in today's India, getting money for an idea is not a problem. You go down one gully in Goregaon, speak to 5 family offices, you get $10 million by the end of 2 months, right? You might have lots of money, but that does not mean you're going to be a great angel investor. Nobody makes money by investing. You make money by getting the money.
Anirudh, so let's just get down to the basics. Everyone assumes that if I have a bunch of money, I can be an angel investor. How true is that?
Well, you can be an angel investor. You may not be a great one, right? Point is that in today's India, right, to getting money for an idea is not a problem. You look at the SME IPOs, they're all getting oversubscribed 100 times, 200 times, 500 times. There is no dearth of liquidity in the market. There's no dearth of money. Founders actually, why should a founder come to you for your check is more important to answer than whether I have the money to fund the company, right? And that most of the time, if you're not somebody who has a superpower, for which reason a founder should work with you, then usually you're getting companies that are probably adverse selected, which means that the top investors have all said no to them, and they're only coming to you because everybody else has said no. Now, is that the best company to invest into?
Yeah.
Right? That's the question really to answer, whether I should be an angel investor or not. You might have lots of money, but that does not mean you're going to be a great angel investor.
So, assuming someone has, run a business, now has enough corpus, what do you think would be the 2 or 3 criteria that you think would make him fit to be an angel investor, and what should he be looking at in the companies he puts money in?
First things first is how much time can you give? So you have to give, on average, when you're investing in a company, you should be doing at least 60 to 80 hours of due diligence per company. Man hours, not just, so that means if you typically can give 3 hours a day, there'll probably 20 days worth of due diligence needs to be done before investing.
Yeah.
Post investment, right? Now you have to do regular check-ins with the startups. You have to get regularly involved in the critical decision making that's going to happen. Now, obviously, if you're going to put like a 2-3 lakh rupee check, no founder is going to come and ask you for that sort of knowledge sharing. But if you have a significant enough check, obviously you'll have rights in the shareholders agreement. Now, if you can't provide that kind of time, A, towards selection and B, towards nurturing, then you're not going to get the result you're looking for in angel investing. So there is a lot of studies. India is obviously very young, but also studies in the West. So there's this thing called the Kaufman Foundation. And they've actually published a report that the returns from a actively managed angel portfolio versus a passively managed one, the actively managed one is 2.5 times more in terms of IRR. So instead of, I think the actively managed one, so the passively managed one should be about 22%. They're saying the actively managed one should be over 50%. But actively managed means you have to have the time. If you don't have the time, then don't invest a dime.
If you don't have the time, don't invest the dime. I love it. And, it's risky business as well, because data shows that, maybe 9 out of 10 times the startup that you put your money in is not destined to do that well. So what's in it for an angel investor, or what's the risk profile that you need to have, or the mindset before investing?
I think this is a misnomer that you get one good startup out of 10. You don't. If you don't have a good deal flow coming to you, you might get one good startup out of 100 or out of 1,000. Because there are 1.4 lakh startups as per DPIT in India, right? Now, that doesn't mean that they're all amazing startups.
Yeah.
There's 1.4 lakh startups. Now, you have to decide what of those 1.4 lakh startups actually are the good ones.
Yeah.
In those good ones, you might have the hit rate of 1 out of 10.
Yeah.
But if you have, let's say, let's look at land. There's lots of land available, right? Now, if you end up buying a bunch of land that is swamp land, right, and you can't build anything on it, you have acres of land.
Yeah.
You have 1,000 and 2,000, 10,000 acres of land. Amazing, awesome. You won't make any money on it, right?
Yeah.
Now, that's the whole thing with startups as well. Do you have the ability to invest in all the 1.4 lakh Indian startups?
Yeah.
Wo possible hai? If it's not possible, then you have to choose the top over there. But why should they come to you? If you don't have that deal flow, the 1 out of 10 math doesn't work.
Yeah.
That math becomes, probably 1 out of 1,000, and that's why you're going to end up with subpar returns.
And I'm sure you guys as well have a very rigorous process in terms of vetting the startups, those checkpoints, those few things that you think are absolutely necessary before you're going to put in the money. What is that criteria? What does the list look like?
So the first thing we do is that we don't look at companies that are not referred to us. So we have a strong referral network, which is our own investors, our limited partners. Then we've got other fund managers, we've got accelerators, we deal with a select number of bankers, and then obviously friends, families, stuff like that, right? Unless and until it comes from that network, we don't look at the company.
Okay.
That way I have confidence that whoever I'm dealing with is somebody that somebody knows, and I can at least vouch for the numbers or the things being said by them. That's the first level filtering for us. Second, we start looking at, okay, are you solving a real human problem? Right? You have to solve a problem that is fundamental, not incremental, not just, a lot of companies look more like features than products. Now, if you're building features, you can't build a company around a feature, but you can build a company around a product, right? So we want to understand that, does the founder fundamentally understand who is he solving the problem for? And why is it a problem worth solving? Once you can answer that question, then everything else from there goes downhill, like I was saying earlier.
Yeah.
Right? Like then after that, I'll ask them, okay, what's the unit economics? What's the kind of scale that this problem has, right? What's the moat you have in this business? Is it technology enabled or not? And what is your right to win?
Yeah.
Why should you be the founder? Like, usually the best founders, in my opinion, are the ones that have personally experienced the issue and then are building from a place of passion.
Yeah. They have
For
the
that,
fire in their
exactly,
belly.
because that person will work 24, 36, 48 hours in a day also.
Yeah.
And they're not 48 hours in a day, but I'm saying that.
Yeah.
Because for them, they have to solve this problem.
Yeah.
They're not out there, all the valuation, money, all that is all secondary. Solving the problem is primary.
Yeah.
Now, those kind of founders are the best, that they have a right to win.
Yeah, absolutely. And, you have invested in startups that, of course, have gone on to do very well, Purplle, OYO, etc. Just give us a sense as to a personal experience maybe that you'd like to share with us as to what the thought process was for you, the kind of background work that you guys did, and how that story panned out for you. Any example of any company that you'd like to share?
Great question. Yeah, I think, so if I talk about Agnikul, right? Everybody now knows the company. But about 5 years ago, when space tech in India was not even a known entity, right? We were still dealing with e-commerce at the time. There came two founders who said, we want to build rockets in India. And I was shocked when I read that. I was like, you want to build rockets in India? Are you serious?
Crazy.
Yeah, I mean, we can barely get, renewable diesel companies or something like that approved. And India wants to build rockets in India. But there was a burning passion in these two individuals. So we still went to IIT Madras to go see the operation. And I could not make it, but the team that went, they came back completely wide-eyed. They said, we have not seen this level of emotion, energy in a company before. They said, while they were in a 1,000 square foot room, and probably about 40 people in that, 45 people like crammed into this room. They're all working with screens and building this rocket. He said, we could not get through that room till each and every person explained how and what they were doing for the rocket. So, great idea. They said that there is a huge problem in this small satellite space. The small satellites don't get space to get to space. And it takes a long time for them to get, to get to space. So by the time they get there, the technology is obsolete. The project has cost overruns, problems like that. Anyways, when Srinath and Mohan presented, my only issue with the company at that time was we don't like to invest in pre-revenue startups. And they were pre-revenue. But I also understand in rocket, it takes a bit of time to get to revenue. So I said, listen, the only thing I can take in lieu of not having revenue is you get me some customers who can tell me that as long as this rocket gets built, they'll put a satellite on it. So I didn't participate in the first round. I said no to that route. About 9 months later, Srinath comes back. He said, now I have MOUs with customers. Here are the MOUs. I think it was $10 million worth of MOUs. They're all saying that as long as you have a rocket,
Yeah.
I'll put my satellite on it. I
Yeah.
said, good. Now I can take this to my investment committee and get approval. We invested in that company. Then I think we invested like a few days before COVID hit. So when COVID hit, suddenly the entire supply chain goes for a toss. Now, how are you going to get things from overseas to build rockets in India? So one of our LPs also stepped in. They actually work with ISRO and NASA. So they helped with the supply chain issues, right? By the time June, July rolled around, suddenly the magic happens, right? That government says ISRO can now do private launches, which completely fell into the lap of
Change the game.
changed the game completely. So then we decided to another round immediately to accelerate production and get this rocket going. And now I think they've gone through about 4 or 5 rounds of financing. They've raised something like 60, 65, $70 million till date. But they've also got that rocket to work. May 30th, 2024, their test rocket did a suborbital launch, did a vertical launch. It took off. Every single parameter that they wanted was met. And what really was exciting to hear was, I think Agnikul was one of the fastest companies to get from blueprint to a suborbital launch, probably in the world, like less than 5 years. But they also probably were the cheapest ones to do it. They've only spent 40 million out of the 68 million. 40 million in India.
Wow.
Like this is for the world to know that we could build a rocket and get it tested, 3D printed, liquid cryogenic engine, and get it into space in under $40 million. I don't think it can happen anywhere else in the world except for India.
Okay, Anirudh, I'm going to make things a little interesting. I'm taking out my wallet, not to give you any money, permanently
I'll
at
take it if
least.
you have.
I've got 500 rupee notes. I've got 10 of them, 5,000 bucks. And if you had to take this money and sort of allocate it when it comes to angel investing, all the factors that go into it, how would you do it?
I need 2 more thousand.
Why do you need 2 more thousand?
I need 7,000.
Okay. Let's give you the 7K then.
All right.
Okay.
Cool. Can we clear this table?
Yeah.
So obviously I asked 7,000. There's the reason for that. 1,
Okay.
2, 4. Total is 7. So this is how I would allocate it, right? Seed investing should have about 1/7 of the capital, which is roughly 15%, right? Then as the company grows, and this I'm talking at a portfolio level, when you're even looking at this overall, you're going to have a situation where you will have, let's say, 40 companies at seed, right? Out of which, when we go to the next round, 50% death rate, you assume that, right? Not they may not be dead, and just assume that you're not going to invest in the bottom 50%.
Yeah.
You only put money in the top 50%. Again, at that point, you will double your check. So that's 2,000 rupees, right? And now again, let's say 40 went to 20, now 20, next round, Series A.
Yeah.
Again has to go down 50%. Bottom 50% written off, right? Again, I'm not saying that they will be written off, but what I'm saying is you're only investing in the top 50%.
Yeah.
That's it, right? And that's where I want to put the most amount of money, because now I have seen the company for at least 36 months, assuming an 18-month period to raise a round.
Yeah.
If after spending all that time before investing, doing the due diligence, and after 36 months, my thesis on investing and the company is doing what it's supposed to do, my largest check should be coming at that third round, because I have got enough conviction, enough data, enough comfort now to say that this is going to be winning investment. And there you go. So I'll put my last 4,000 rupees at that level. Now, however, this is a very simplistic when I'm explaining it on a one investment kind of a journey, right?
Yeah.
But if you look at it at the overall portfolio level, right? Now let's do the math. We put 1,000 rupees into 40 companies. Total 40,000, right? Then we took 20 of those companies and gave them 2,000 rupees. Total 40,000 again, right? And then we took 10 of those companies and gave them 4,000.
Yeah.
40,000 again.
Yeah.
So technically what I've done is I've divided this entire portfolio into 3 separate chunks, but I've incrementally added the most amount of money into the top 10 companies. So my total portfolio, if you count it as, if you count 40, total is 120, like 1,20,000. But my top 10 companies have 7,000 rupees of that each, which means 70,000 out of 120 is in my top 10 companies. Now, does my portfolio have the best chance of success when more than 50% of the money is given to the top 10 companies? Even now, if one of them becomes massive, right?
Unicorn.
It will unicorn, even before unicorn, right? It could be possible because if you smartly allocated their capital, and you have a large amount of money at play in your best companies, even as, I mean, we had this situation with Karza Technologies, right? Karza is a company I was invested in, got acquired by Perfios. They only raised one round, like 2 rounds. Like the seed round, the pre-series A got acquired. But in that journey, they generated 65x returns.
Yeah.
Right? And I had in that portfolio, in that part of that portfolio, it was one of my largest investments. Right? And I had only given them 2 rounds. Itna hi hua tha. This had never happened.
Yeah.
We were doing this and they got acquired.
Yeah.
And guess what? They returned 3 times that portfolio.
Yeah.
By themselves. So that's how I would allocate it. You have to understand 1/3, 1/3, 1/3 at a portfolio level, at a company level, 1, 2, and 4. Double down, double down.
Got it.
That's the way you should be allocating capital.
Okay, so that's a super interesting way to have really put it. So if you had to say, if you had to foresee right now, I know you said that you get pitches that are only recommended to you guys, but what do you believe are some of the more promising or exciting themes that are coming up?
I think fintech infrastructure is going to be huge in India, right? Okay. We still have an economy that has only credit card penetration at 80 million, right? 80 or 85 million, something like that. We have over 1 billion debit cards. In the June 2024 quarter, the expenditure on 80 million credit cards was more than 3 times the expenditure on 1 billion debit cards. So just tells you what is going to happen with more credit in the economy. It's going to make the consumer ecosystem explode. However, people are not just getting enough credit cards, right? Because legacy issues, I think the fintech infrastructure in India is not there to be able to do fast lending. It has to get built. And I think that over the next 7 to 10 years is going to take our economy from where it is today to where it's supposed to be.
Yeah.
And any economy that wants to have a consumer ecosystem working needs to make sure that there is a credit ecosystem that can support.
Yeah.
Because until maybe 10 years ago, we were an economy where what I had earned yesterday or day before yesterday, I spent today. But now we're quickly becoming an economy where that I'm securitizing future income. What I'm going to earn tomorrow, day after, and the day after that, I will take a percentage of that and spend it today, and I'll buy the home, the car, the experience, the Instagram passport hotels or whatever, right? And I want to do that today, and I'm willing to sacrifice something from my future to make that happen today. Now, for that huge transition to happen for 1.5 billion people, an entire fintech infrastructure is required, which is what needs to be built out at scale.
Okay. If I may, and sorry, I'm going back. We were talking about angel investing being a bit of risky business as well. So typically for someone who's looking at angel investment as, a means of investing in their portfolio, how much of a percent do you believe that they should be allocating to this?
I think it depends upon where you are also in your life, right?
Okay.
So obviously, as you're younger, you should probably be taking higher risks because you have a longer time to even, compensate in case you do go wrong. But I would say at least 10% of your overall investable corpus should be in private equity. Now, again, this is not true for everybody. Let me be very clear. I don't think anybody who does not have at least 20 crore rupees in liquid should be investing in angel. Because this money is not coming back, remember, right? So if you're somebody who has only 1 crore rupees and you start putting 10, 15 lakh rupees in angel, first of all, that money is nothing. That's only enough for one company investment. Right? And I'm saying this with a lot of humility, but I'm telling you this, that you can't diversify that 15 lakhs into 10 companies because you're going to get 1.5 lakhs per company. Which founder will come to you for 1.5 lakh rupees?
Yeah.
Right? You're better off going to small caps and doing all of that stuff over there. So it has to be a large enough corpus, right? So I would say at least 20 crores should be out there. Obviously, you've got part of that in debt, part of that in equity, and then you've got about 10%, a couple of crores to put into venture. And then you have to start deciding what my thesis is going to be from there, right? Yeah. I'm going to put money into how many number of startups. 2 crores is also, I think, the bare minimum start price. I think if you've only got 2 crores, find a good fund manager, give him the money or her the money, right? Because they will have teams to go out there and diversify. For 2 crore, you can't afford to get all the angel invest memberships, look at all the deals, then also have a team to evaluate, do the due diligence, make the investment, do the nurturing, read the SHAs. It's a process.
Yeah, it's a full-time job.
Right? I mean, so I feel ki people feel that, I love flying aircrafts.
Yeah.
But that's not the same as running an airline company. Yeah. I think that's always been the issue, right? Everybody wants to save some cost here and there, but you're forgetting the big thing that, for that 1-2% management fee, whatever getting charged, there's an entire team doing work there. which you can't afford to do for your 2 crore investment.
Yeah.
Why would somebody work with you? The average incoming salary of an analyst is about 12 lakhs. If you're paying that on a 2 crore portfolio in 6 years, can you imagine the investment cost?
Yeah.
So it's very easy to say that, everybody should be an angel, but I think the better strategy is invest alongside funds. And whenever there is an opportunity, if it shows up, where the fund says, hey, there is some company that may be looking for some extra cash, and you think you have some sort of a insight that others don't, and you could put another 5 or 10 lakhs at work over there, then do it. Again, be discerning. Don't look at, just because a fund offered it doesn't mean that it has to be invested into.
Yeah.
Do your own due diligence, do your own research, talk to the founder, get your comfort, be comfortable. And it's, again, one of the things when I started angel investing was that it is not my job to be as smart as the founder to understand what they're building. Because I'll never be the smartest guy in the room.
Yeah.
I believe that I'm not the smartest guy, but I want to see whether the founder is smart enough to dumb it down for me so I can understand it.
Got it. Yeah.
Right? So like I'll go back to the example of Srinath, right? So Srinath explains what his company does using the example of a bus.
Okay.
He said you can buy all the seats in a bus, you can buy some seats in a bus. That's what we're building as a rocket company. Instead of buying the entire bus, which is very expensive, you can buy like 10 seats in a bus, and you can ride along other satellites. Isn't that very simple to understand rocket technology versus he could have talked about, flow rates and thrust and you'd be like completely bouncers. So I think that is fundamental.
Yeah.
The best founders, because that also tells you how well they can sell their concept.
Yeah.
Right? So I would again say that it is not, if you don't understand something, do not invest in it.
Yeah.
It's better to not have made money in something you did not understand than to have made money and you don't have no idea what you learned from it.
Yeah. That is one mistake, you think. What are some of the other classic mistakes? Because I've noticed there are examples also like, you hear of stories like a Nykaa or an Ola and you say FOMO, I missed the bus and stuff like that. And that is a big reason that people jump onto this angel investing bandwagon. What else, or what are the other things that you think are classic mistakes?
Investing and forgetting about it. Right?
When it comes to this.
When it comes to investing.
Yeah.
This is not a stock market investment where companies are going to give you quarterly reports and SEBI's out there helping you out.
Yeah.
Right? In case they don't put their reports or penalizing them. This is private investing. The rules are not the same. So many of the times, let's say you are an angel that has enough money. What I notice also is that they'll do spray and pray. Their intention is to do 80 investments in a year, 100 investments in a year.
Yeah.
And I've heard family offices that I also work with, like, we did 100 investments last year. I said, how? You've got a 2-person team. I said, I have 20 people working in the investment team that we have, and we can barely do 10 deals in a year. How are you doing 100? It's all spray and pray.
Yeah.
It's like, just keep investing in everything that comes to you.
Yeah.
And then let's not follow with anyone because we're too busy investing.
Yeah.
But anybody will tell you, and Pulak Prasad is one of the guys I love for this, right? That in a 25-year career of investing, the investable days is less than 1%.
Yeah.
I tell that to each and every person that joins our team, that if you have come here only to invest, then you've come to the wrong team.
Yeah.
We spend 90% of our time on the portfolio, 10% of our time on deal flow. Because I have to only make 10 investments in a year, but I have to manage 120 investments at the moment. So money is going to get made in managing portfolio.
Yeah.
Nobody makes money by investing.
Yeah.
You make money by getting the money back.
Yeah.
Right? सिर्फ पैसा लगाने से पैसे बन जाते हैं तो फिर क्या बात है?
Yeah.
Right? When you get the money back is when you make money.
Yeah.
And I think most people forget that aspect, that they invest, then they don't follow up, they don't nurture, things are happening in the company, you have no idea what the heck is going on.
Yeah.
And then when it blows up, you blame the founder, the angel, the lead, whatever.
Yeah.
But the point was you weren't paying attention either.
Yeah.
And if you're so busy with other stuff in life, do not become an angel. That's what I said earlier, right?
Yeah.
Find a good fund manager, pay him that 2% management, him or her the 2% management fee, and let them do the job that you don't have the time for.
Yeah, or the ability or any of that. Yeah. What has been your view or opinion on some of the companies that we've seen listing, the valuations that they command, this IPO rush now that we're seeing coming right back after, I think, 1 year of introspection? What do you make of it?
I have personally not participated in any of the IPOs.
Okay.
Right? And I obviously keep hearing about XYZ companies available. at whatever price, and Sky IPO is going to happen in 6 months or 18 months or whatever, and they valued at 10 billion, and I'm getting the shares at 8 billion, or now they were 15 billion or whatever. Like all
you
this.
don't feel FOMO. You don't feel that's an opportunity I want to.
I am very comfortable knowing what I know.
Got it.
And what I don't know, I don't want to make money on that.
Okay.
I don't want to gamble.
Okay.
I'm not in the gambling business, right? So if I was in the gambling business, I would definitely have FOMO.
Yeah.
In fact, they also call it JOMO now, right?
Yeah.
Joy of missing out. Right? But I feel ki some of these IPOs, some were really good IPOs.
Yeah.
I think, but many of it is also, there is just so much liquidity chasing these stocks.
Yeah.
I fail to understand that how you're going to make money in this if the market corrects 20%. Right? I think some of these stocks are trading at 100 PE, 150 PE. I've seen some stocks that have no PE, and they're listed. I'm very much Warren Buffett in that I like to be conservative, right? I want to buy great companies at good prices, right? But I don't want to just be invested for the sake of investing and then keep looking at the stock price every day, that has the music stopped,
Yeah.
Am I sitting in a chair when the music stops?
Yeah.
I don't want to be that guy.
Yeah. You want to spend your Sundays, Shanti, say get a good night of sleep. Right?
I sleep extremely peacefully, and I want to be that to me is my number one requirement, that I should be able to go to sleep every single night, knowing that my founders are good founders, right? They're doing good work, and that even when I'm not looking, they have enough character to keep building what they have to be built. Yes, market will sometimes not work in your favor, and I'm completely okay. I mean, obviously we've had a lot of write-offs. I'm not going to say everything has been. Out of 120 companies, we've exited 32 companies till date. We've also got about 20-25 companies that have been written off. That's a part and parcel of the game.
Yeah.
But I can tell you, each one of those companies where we invested, what were we trying to do, what we thought the thesis was, many of the theses were written out. Not later on in life, we started also writing them out. And what went wrong, and what we learned, and how we implemented that in the next cycle.
Yeah.
Now, if you're not doing that consistently, you won't become eventually a good investor, right? Nobody starts out, nobody was born a great investor. We all became, we all become good at whatever our professions are. Yeah. And unfortunately, if you're not, if you're not paying attention, you're not just going to learn. You're just going to be investing, and then you're like, oh, this thing doesn't work.
Yeah. And you spoke about doing this, you've done this long enough. What do you think have been, like you said, it's not always rainbows and butterflies. You haven't hit the jackpot every time. So if you could nail it down to maybe 3 or 5 biggest learnings that you've had in your experience here?
A, don't chase the returns, right? I think many of the time, and especially even founders sort of are responsible, maybe bankers are responsible for this as well, that, invest in XYZ company and this will become 80% IRR and this will become 10x and this will become a unicorn. Those emails are deleted right away, because they themselves don't have any idea what it takes to build a unicorn. We've been invested in 5 unicorns till date. Each one of them has a different trajectory altogether. So it's not like, it's like saying, somebody comes to Goregaon, right, or Film City, wherever that is, and says that I'll become Shah Rukh Khan.
Yeah.
Is it easy to become Shah Rukh Khan? Yeah. Do you know what he had to go through to become Shah Rukh Khan, or to become, Hrithik Roshan or any one of these guys? Each one of them has a story, right? And they have a very different trajectory to becoming superstars. Yeah. And
there are a million failed Shah Rukh Khans.
Exactly. Yeah. They're not, probably a billion failed Shah Rukh Khans, right? So it's so start telling, like when you're investing as an investor, don't chase the returns. The returns will come as long as the selection is good. Yeah. As long as the people you're investing are good, right? When all those things are good, then great things can happen. But if you start chasing things, maybe he doesn't know what he's doing, but it's a great price, and I think, just imagine if this becomes 100x. That's gambling. Yeah. So get out of this gambling mindset, right? Start, if you're going to be an angel, if you're going to be even a stock market investor, do your research, right? It only pays you back when you do the research. So that's number 1. Number 2, like I said, don't invest in things you don't understand. Don't invest in structures you don't understand. No startup should create complicated ownership structures, because that is only going to lead to one thing, which is suboptimal returns. Yeah. Right? So simple company structures are the best ones to invest in. And I think maybe a third one that could be there is that be conservative when others are greedy, and be extremely greedy when others are conservative. It's very much like stock market cycle.
I was just going to say.
Yeah, right? It's crazy, isn't it? Yeah. like right now is probably the best time to be investing in seed stage startups because nobody else is
Yeah.
investing. There's no money,
Yeah.
right? But what happens is right now everyone's fearful. Oh, I don't know what's
Yeah.
going to happen. It's a cycle. It's changing. You know what happens? Then 2022 happens, and then you are like, oh my God, I missed out on everything.
Yeah.
Let's just put money everywhere.
Yeah.
And then 23, 24 is about to happen.
Yeah.
And then you'll be like, कि अरे मैंने 100 company में डाला था. 85 of them failed.
Yeah.
5 of them ran away with the money. And then 10, I don't know what the heck is going on. So this is a really bad investment product. So no, it's a really bad investment strategy, not a product. Because there are enough people and more. And you would know this as well. Even in the stock markets, only 2% of the people make all the money.
Yeah.
Right? 98% are always losing money because 98% of people are traders and 2% are really investors.
Yeah. Report out today about how youngsters are
Think about that.
jumping on the bandwagon and not everyone's making the money.
Yeah. They're just, I think they feel that this is some sort of a game.
Yeah.
Right? And
That's
this is real money.
Yeah.
I think that's where that financial education is very important, that be patient. Returns don't come in 1 or 2 years.
Yeah.
The best companies are the ones you hold for 10 years.
Yeah.
If you really want the compounding effect, where you make 200x, 300x, 500x, if it happens in 1 year and you do it consistently, you have something that is incredible.
Yeah.
Right? So you're probably doing something illegal, is what I would say, right?
Yeah.
Okay.
Or a superpower.
But the superpower would have to be like you've got some time machine that you can go 1 year later and see what the heck happens, right?
Yeah.
But aisa to nahi hai. But usually, I would say that the best compounding returns are the ones where you're invested, stay invested, stay connected.
Yeah.
And the best returns will happen in 10 years, 12 years. And that's what I was telling you earlier, that if you have 15 lakh rupees or a 1 crore portfolio, and you've got to forget this money for 10, 15 years, how many of people would have that kind of capacity with that kind of a portfolio?
Yeah.
So better off, the guys or the people that would have 20, 30, 40, 50 crores as a liquid investable portfolio, net of your house, outside your house is not included. Those are the guys those are the people, right, that this product is built for.
You said you immediately delete the mails when they say, I'm a unicorn, I'm going to be the next one, whatever. But what about when you meet people? And I assume you meet a lot of people who have a lot of things to say. Can you tell, like, immediately?
I think you can. I don't think you can tell. Like, I don't think there's like when I meet them, I can tell. I get an inkling sometimes.
No, after they start talking.
Yeah. So usually it's the question answers, right? So what I get into is that I always get into the numbers. And I start questioning the numbers, or I start questioning that recently there was some pitch call and someone said 90% of people believe that this is a problem, whatever that problem was. I said 1 second, where did this stat come from? Right? So then immediately there's like, oh, we surveyed 90 people or so whatever. We surveyed people and 90% of them. I said, okay, and who did you survey? So obviously it's already a tainted class because they've only surveyed their friends' families. I was like, how can that? And I said, do they know what venture you were in? So I said, now they have a bias to make sure they give you the wrong answer. So this is not a proper survey. You can't say 90%. Right? So I think I get into those little factors just to figure out how well researched or well understood their thesis is. And then I definitely always get into the unit economics. I want to understand that how are you going to make money on every transaction? Because there's no math and I'm not an accountant or did any accounting degree, but I'm an economist. There's no math in the world or any accounting in the world that can take a gross loss and make that into a net profit. It doesn't happen.
So you flagged off some. If you could just sort of be a little bit more specific, 3 red flags or 3 things that you would look at and say, this is not for me, this is not where I would put my money.
No, so I would say that if the founder doesn't know their numbers, that's a red flag for me.
Yeah,
Number one. You need to know your numbers. What was your last month's revenue, last quarter, what's your margins? All these things are really, really important. Number two for me would be that founders that just blatantly lie, right? And that they say something and then they can't follow up on it. Or they, just blurted something out because it sounded
cool, or a statistic.
Absolutely. Just, or they use some, like, best is obviously put AI on anything. Right? And then you're asking them, in your team, who is the AI engineer? No, we're going to hire one. So there's no AI right now. So they're just using the hashtag to get into a deal flow, but they don't really have that figured out. So I think those definitely, and I think a third one for me is definitely etiquette. Right? I find that of late, many of the founders outsource their fundraising to bankers and then allow the bankers to run amok, right? But it shows really poorly on the company.
Yeah.
I think the role of investment bankers is much later in the journey. In the early stages of a journey, founders should reach out to investors directly through networks as possible. And don't always make sure that your banker is under your control and you're not under the control of the banker.
Yeah.
Because that etiquette is that the foundation of a 10-15 year relationship. And if that did not start well, it's not going to end well.
Yeah.
Right? So I think for me, this is probably a new one that I've come up with, that how, what's the founder's etiquette? I actually visit founders' offices when I'm evaluating. I just show up randomly.
Yeah.
I don't even call them. I just, I'm in the area. Can I come and see? Because I'm trying to see how do they treat their employees? How do they treat their customers?
Yeah.
I speak to the customers. My team speaks to the customers.
Yeah.
We speak to the suppliers. We call their previous bosses. We're trying to just understand that who is this person? Because remember, I want to sleep peacefully at night.
Yeah.
I'll go back to what I need to do, right? And for that to happen, this person needs to be working hard, and this person needs to be, somebody I can trust. And for all of that to happen, right? I want to understand what their temperament is like, or what their character is like, and that if that is not available to me, or if I find any kinks in their armor over there, then I know that I can't trust that person, right?
Yeah.
And if I can't trust that person, I can't give them my money, or at least the money of me and my investors.
So Anirudh, over the years, how has the investment style changed or evolved?
I think obviously as you learn, you go back and look at your data. If I'm talking about data to you, then I need to have my data sets as well. When I first started investing, I would just put money in one round, right? And then I started looking at global models, right? And looking at the fact that mostly in the Western markets, which are more developed and mature, an angel investor keeps writing checks till Series A. So they don't stop. Because if you have got a good venture, you want to put more and more money to play in that. So which obviously then means I can't do 100 companies because I won't be able to see what's happening. And then I think when we decided to create a fund, by that time our thesis again had changed. We started saying, it's not just about writing the same check. We actually need to double our check in every round. Because if you've got a winning venture, right, and you've got like something that you have spent time, money, effort, and you've been watching it for 18 months, and they're doing a new round, and because you're inside the company, that it is a good investment. It's a great investment. It's doing good stuff. I double my check. So I call it the 1-2-4 model, right? Which is like, if I put 4 crores at seed, I want to put 8 crores at pre-series A, I want to put 16 crores at series A. Why? Because I want to incrementally add to my ownership across that journey. And with every follow-on round, my risk of the investment is also going down. So I think that is something, obviously, that's a learning that has happened over time. I think another thing that definitely has happened is that I initially, because you're an early angel, there's a lot of excitement and deal karni hai. But I think being patient, right? Saying, hey, if I didn't get that deal because the founder reached out to me saying I need the money by day after tomorrow or next week or the week after that, I'm like, hey, listen, let's just end this right here, right? Because I won't get my 80, 90 hours of due diligence that I need to get done. I won't get my time to talk to people. I won't get my comfort, and I don't want to chase. Right? If I'm not here for the chase, right? When things will be in my favor, they will be in my favor, and I'll invest when things are in my favor. Why should I invest when things are in your favor, right? And especially in a situation where you've come to me with 2 weeks left.
Yeah.
Pehle it used to be like, I have 2 weeks of runway left, and hence I need money. At least it's now moved to saying I have 2 weeks left to close the round. Yeah. So maybe that is a founder evolution also that has happened. But at the same time, I think that being comfortable saying, you know what, I miss Bharat Pay, for example. I'll tell you that. I miss Bharat Pay. Honestly, the founders wrote to me multiple times. They updated me with reports. I at that time could not build a thesis because they were not going to charge for payments. Okay. So they had built this amazing network, all these QR codes, but they were not going to charge for payments. So I kept thinking, how are you going to make money? There's an incredible tech cost. And I never saw that they would eventually build a lending business on top of it. But I think that happened much later. So I've even publicly said it that even if I had the opportunity again, I would have still said no.
Yeah.
Because at that time, the founder did not know I'm going to build a lending business. And if he had told me then, listen, this data will eventually create a lending business. That was their job, not mine.
Yeah.
Right? For me to understand.
Yeah.
So I think
when you asked the question,
I didn't even know they were going to build one. No? Like
no, when you said how are you going to make money, they didn't say this is our game plan.
They just said I'm going to do more and more transactions, more and more QR codes. And I said, then we'll figure it out.
Okay.
Now that figure it out is
your money, you don't want
to I think I don't want my money to be figuring out things, right? It needs to be invested in stuff. So I think that those are the kind of points that matter.
And what about family offices and generational wealth? Is now angel investing an avenue that is being looked at more proactively?
I think we're in the third phase of what family offices are going to do with venture. Okay. First phase was when family offices were exploring. In 2016 we exited OYO. Until then, Indian family offices had not participated in the journey except for a select few, the Infosys founders, very select few were involved. Then OYO happened and then suddenly somebody made some 350x in 4 years and gets covered by the media, all that stuff happened. Then suddenly they're like, wow, there's this asset class, we have to invest in it. So everybody got involved. Like everyone's like, okay, like a lot of family offices came to us and we started co-investing with them. And they were just like, just whenever you write a check, write my check also, right? This was very exploratory. Then obviously they made money on that or some lost money on it, whichever way it went. Then came the second round. They said, oh, why should I pay you? I think this is a very simple game. I understand what this is. So they picked one family member, said you become the fund manager. And then they put money with him and also told him to go raise money from friends and family. And this guy suddenly, became a fund manager. And so all these families, offices had family office funds also, but managed by a person with the sole intention of just managing their own capital. And I think they lost a lot of money in this recent bull run because there wasn't a team, there wasn't a thesis, there wasn't that experience behind the person who they had got as a family member. And it's very difficult to, I think you can't really tell your own family member to be a fund manager and then also be able to reprimand them and ask them for reports. It's a very tricky situation. So I think a lot of family offices that did that stuff in the last 3 to 4 years or 5 years, they've now understood that this is not a game that I can play. So now this is the third phase, which is now let's invest in fund managers. Let's diversify across a bunch of funds. And then let's say I put money in 20 funds and each fund does 20 investments. Now I have access to 400 investments. Now from those 400 investments who are my fund managers, one level of separation, right? I will now find the top 20% of these companies and I'll invest in those in a direct share. Now, isn't that a much easier model to deal with?
Yeah.
Because you've got that first level of DDA that has been done. You've got out of obviously the 400, maybe 50% will not do anything. So only 200 are worth it, out of which 20% is 40 companies. And you'll put money there. And I think that evolution is now happening in this third wave.
Yeah.
And you'll see that game changing a lot because family offices, and I just said this even in an event in Denver where I was speaking, that I don't think Indian fund managers will be appearing in the US for very long. I said, we have to go to the US and speak to funds and then they have 10 different questions and वो 10-15 million dollar के लिए 4-5 trip लग जाती है. You go down one gully in Goregaon, speak to 5 family offices, you'll get $10 million by the end of 2 months, right?
Yeah.
Because that's so much money available in India.
Yeah.
So now global at 2013-14, 90% of Indian VCs got 90% of their capital from overseas. The entire thing has flipped.
Yeah.
I don't think the global investors are getting space in Indian VC funds anymore, right? Except for the very large ones. I'm just saying most of the funds, you can raise capital in India. Why would you go all the way there?
Yeah, here's where it's at.
Yeah. So I think that paradigm shift is happening where family offices are getting very, very active. Obviously, we had a record number of M&A years in the last 4-5 years. Business is getting sold, business is getting listed. Lot of liquidity coming into the system and families going, okay, now I receive 4,000-5,000 crores. What do I do with this? And if I'm going to allocate, like I said, 10% of that to venture, that's 500 crores. I have to allocate that smartly. And therefore, they've got the CIO and the teams and, multi-family offices being created. All of this is just great stuff for Indian venture.
Anirudh, it has been so insightful, really learned a lot, and I'm sure our viewers are going to go home with a lot of pearls of wisdom that you've shared. So thank you for taking time out.
Thank you so much. I really enjoyed this conversation. Amazing questions. Loved all the get-ups and setups, and I had to give you 7,000 rupees back.
Yeah. Thanks for tuning in to this episode of Temperament. Would you consider angel investing? Comment below.
And always remember, for any personal finance decisions, including angel investing, it's always better to take advice from a qualified financial advisor. They can guide you according to your unique needs and goals to help ensure your financial well-being.
We'll catch you in the next episode.